All right. Welcome to another episode of Millennial Money Matters with Kelly Turner.
And Derek Mazzarella.
And what are we talking about? I don't know, Derek. So what you've all missed in the pre-recording phase of this is like both Derek and I are apparently in chaos at the moment.
Yeah, a little saucy this week.
Yeah, we are recording this on Thanksgiving week.
Yep.
Which maybe poor choices. I just got back from a weekend with college girlfriends in Vermont. So I'm like, my voice is gravelly, my hair is in a bun. I'm a little bit of a mess.
Yeah, we can't hang like we used to. That's the problem.
No, man, you can't. You turn 40 and staying up too late having some wine is problematic.
So what was the playlist like? Were you guys bumping like 2000s hip hop or what's the status?
We have a special curated Spotify list that we share that is curated. I would say college beats circa 2003 is probably the average. There was a lot of Usher.
For sure.
Yep.
You're not saying it right.
Some Ludacris.
That's my guy.
Yeah, it was great. It was great.
That sounds awesome.
Yeah, I listened to John Mayer the whole ride home. I'm I just need a break from this. I need a little breather.
That sounds like a fun weekend, though.
I mean,
no kids, right? So that's always a bonus.
No children to be seen. We did weird stuff. We woke up at 8:30. And
you were able to sleep till 8:30? That's actually more impressive.
It was amazing. It was amazing. I ate breakfast and nobody tried to eat my breakfast on me because that's my current life right now is the moment you start to hold something and put it towards your face. My son is like, me, what is that? What do you got there? Get it over here. I want to try it.
I don't have that problem. I eat a lot of green smoothies in the morning, so my kids are give me some of that. They're never I want some of that.
That is the most 40-ish-year-old statement
This body doesn't just happen, Kelly.
Oh my God, green smoothie. Blah.
Yeah, a lot of spinach.
There you go.
A lot of avocado.
No.
It's very healthy. I'll give you the recipe.
That sounds disgusting. Disgusting. But no, it was a great weekend. I'm here. And it was funny because what we're talking about today was a little bit relevant to my weekend.
Yeah, so we're going to start with two things. The real theme of today is real estate versus stocks. Right, so we're gonna challenge each other on that stuff. But I think we're gonna start with a little topical news because we were very late in recording this and we have no episodes left to post.
So this is going live next week.
It's going live pretty quick. So we're gonna talk about what's the deal with the 50-year mortgage. We said Mr. Trump was like, "Hey, let's just extend this out because everything will be cheaper."
Yeah, well, it's already done. It's already gone. We've already gotten rid of it. So it will not be happening. We got a new plan for a portable mortgage, which we can talk about too. But a 50-year mortgage was a contemplation, right? The longer you're paying your mortgage for, theoretically, the lower your monthly payment is.
Yeah, well, it makes sense, right? Because if you're extending things out, you're going to have a lower payment.
Correct.
Like if you do a 5-year car loan versus a 7-year car loan, you're going to have a lower monthly payment.
Exactly. But what is the flip side of that? There are two things. Number one is mortgages are paid, the way they amortize is you pay way more interest at the beginning.
Yep.
So this just extends the amount of time that you're just going to mostly pay interest. So if you try to sell your house in 5 years, 7 years, which is the average length of time somebody lives in a house, you're going to have zero equity.
None. Yeah.
None. Zero. And the other thing that happens with it is think about the difference between 30 years and 50 years. You're not at double the length of time, but you're close to it. So how much more interest are you going to pay?
Think if you buy a house at 20, you will pay that off at 70.
Mm-hmm.
You will have a whole lifetime.
Yep. And you'll pay literally double the interest. So if you're normally going to pay $400,000 in interest in your house, you're going to pay $1 million. People, you don't want that. And okay, fine. What are you saving monthly? People are like, oh, you're going to save a ton monthly. You might save a couple $100.
Yeah.
It's not an enormous amount of money.
And the other challenge I see with that is like anything they kind of think about doing this, government, both sides. When you make something cheaper on a monthly basis, guess what's going to happen to the value of it?
Yep.
It's going to go up. So it's probably going to negate any savings anyway because it's not tackling the real problem, which is supply.
Correct. 100%. The other thing, too, is, which was the point that I made on the internet when this all came out, is it's also illegal under the Dodd-Frank Act.
Is it really?
You cannot have anything over a 30-year mortgage. Because if you think about it, if there were more options, they would already exist. Right. If it was legal to have more options, we would already have them. Some bank, some special lender would have already offered a 50-year mortgage if there were no limitations.
Yeah.
They don't have them because they're considered predatory.
Well, they would sell to anyone, right? Oh, well, you're making nothing. Well, here, we'll give you a 70-year mortgage. You can finally buy a house.
Correct.
Cool.
Correct. Yeah, and Canada tried it for a little bit, so they dabbled in 40-year mortgages. For the same reason. Canada has a worse affordability problem than the United States does. I don't know why, man. There's a lot of places to live out there.
It's all the moose.
It's all, yeah. But where people are living, it's incredibly expensive. All of Canada's like living in California. It's just.
Well, because you know there's like 97% of the population is within like 7 miles of the U.S. border. Or something ridiculous
it's
like
one
that.
little line of people. And so they tried to have 40-year mortgages. They realized after a few years that it was an absolute disaster. And they actually reduced it now. So their max is 25 years. So they lowered it under the 30. Again, in the sense of what are you actually solving? Nothing.
Yeah.
You're solving nothing. So 50-year mortgages, they were here. They were gone.
Yeah.
We don't have to worry about them anymore. And we're like, we're dabbling in other things.
What's the new thing you mentioned? Sorry.
Portable mortgage.
Portable. Oh, I don't even know what that said. Oh, you can move it from one house to the other house.
You can move it from one house to another house. So say you buy a house for $400,000. You take out a $300,000 mortgage. It's got a 3% interest rate. You move to a new house. You take your $300,000 mortgage at 3%. You move it to the new house. If you need more money, you would take out the additional money in a second lien at whatever the current rate is. So maybe you need another $100,000. So you would have 300 at 3% and you'd have 100 at 7%. And you could theoretically keep stacking these. And that's the part that nobody has really like fleshed out that I've seen yet. Like, okay, cool. Like one time that makes sense. But like some people move every 2 or 3 years. Do you just keep adding these new mortgages with new interest rates? And like,
yeah, that seems like an insane thing to A-track. I don't understand how the banks would be like, yeah, this is cool. If I were them, I'm like, yeah, pay that 3.5% mortgage off. And then I'm going to give me a new one for $350.
Yeah. Well, and like, it's also a title insurance nightmare, right? So like when you're trying to clear title is essentially like the chain of ownership of a home. How many people have owned it? Is there any money owed on it? You're now tracking all of these little tiny liens that are much harder. And what if one gets sold off to a new lender, which happens all the time? Like, how are you going to track all these things? Are they all going to be considered mortgage loans tracked in the mortgage repository? Like we don't, again, this is not a fleshed out idea. Sounds great in theory. First and second loans already exist. Like you can have 2 loans on a house. You can have even 3 loans on a house. But the way that they're talking about this sort of moving loan, I just think sounds really complicated.
I don't think anyone wants to deal with that.
No. Yeah. A lower interest rate sounds great until you look at it. Well, and so you can do that right now in something called an assumable mortgage. It's actually not you porting your loan over. It is somebody else taking over your mortgage.
Yeah.
So there are a few loan products that allow it. FHA, VA do. They rarely ever happen because where are you going to get the rest of the money?
Yeah, that's the problem. You would have to assume you have the other cash to put down on the other house.
Correct.
Right? Or you just say, hey, like I'm going to start renting. So that's a moot point. But like, because you could also do seller financing too.
Yeah.
Where it's like, all right, I'm going to keep my mortgage, but you're going to live in the house, own it, but I'm going to pay you a little bit more than what the mortgage is anyway. So I kind of make a little bit more. So it's like a different way of being a landlord, but
Correct.
not really being a landlord.
Yeah.
Yeah.
That's the life we live. It's whatever we can do to make it
I think
work.
we need more complication in the housing system. I think that would help everyone, right?
Yeah, more complication because it's such a good investment, Derek.
Oh, I think we're going to have a little tussle about that one.
Such a good investment.
All right, well, I want to get into it. Why do you think, all right, are you the person that says my home is my investment?
Well, yeah, my home is definitely an investment.
Is it a good one? That's the real question.
It is a good. Well, so I think I want to break down a few things here. Is number one, when we are talking about real estate as an investment, we're not just talking about one item, right?
Yeah.
We can be talking about the house that we live in.
Mm-hmm.
We can be talking about a residential investment property.
Yeah.
We can be talking about a residential second home, or we could be talking about commercial real estate. These are very different things. When we say real estate investments, did I just throw one in for you on the commercial, or was that taken into consideration in all your charts, Derek?
I didn't look at commercial.
Yeah.
I was kind of strictly looking at this as all right, is the home that I live in an investment?
An investment.
But we can talk about the other stuff because I think I think all the other stuff is an investment when it's you're out of the house. To me, that's when the case is a little bit better for real estate than it is for I own my home. And I'm gonna throw it back at you. I feel like your home you live in is not an investment, but it is an asset.
And
I think it's
do like
different.
that. Yeah,
Because I think we need to look at it a little differently because there's utility part of it. There's the, all right, we had the episode last time with your husband on about, all right, do I invest in the deck or do I invest in a finished basement or do I invest in the kitchen?
Yeah.
Right. Like that's a conversation you should certainly have with yourself and it could push value of your home up. but the ROI on that is still pretty minimal.
Correct.
Yeah, but sorry, go ahead.
Yeah. So I think, when we talk about investing in real estate, there's sort of a few different ways that you can do it. An investment in real estate and sort of, as you said, and your house are not exactly the same thing.
Right.
One of the contemplations in this too is, right, if you do not own your home, where are you living?
You're renting.
You're renting.
Or living with mom and dad or grandma.
That's the best deal you could have. Live with mom, dad, or grandma. Truthfully, if you want your best case scenario in all of this, it is to live for free with somebody else and invest all your money.
Yeah. Just your best investment is your parents buying a house.
Yeah, that's really the winner. But if that's not feasible for you, owning a home is a better investment than renting. Full stop. In almost every circumstance. Over time.
Oh, we're going to find out about that.
Yeah.
We're going to find out about that because I ran some numbers.
Oh, okay.
Should we get into it now or should I'll let you finish your point because I know we're doing point counterpoint.
No, I want to know. I also would just like to point out to everybody who is watching, this is a Derek versus Kelly showdown. My notes are on my phone that I chat GPT'd and I had my ideas in the parking lot when we got here. Derek has charts and spreadsheets that he's made.
Yeah.
So, this is definitely also a type A versus type B battle. So type B over here says, tell me about your charts, Derek.
Okay. All right. So I did some numbers and I did some research using Perplexity. I'm not a ChatGPT person for research, but all right, here we go. So I focused on Connecticut because we live in Connecticut and it's the 17th best state in the nation, give or take. I don't know where
17?
I don't know. What do you think it would be?
I think
top 10?
Yeah, I think it would be top 10.
It's the foliage. Okay.
No, we don't have good foliage. That's Vermont. But listen, I fell for the propaganda. I fell for the Connecticut. Not that I'm not a townie, but I am fully here for the Connecticut propaganda. We're on the shore. We're 2 hours from ski mountains. We're 2 hours from 2 major metro cities. You can fly out of major airport hubs. There are you've got everything here. So
even Hartford, which is the coolest city in the world.
I
right?
didn't
Everyone
say
talks about.
Hartford. I said 2 major metro areas, neither of which is Hartford.
Okay. Yeah, I'm assuming it's going to be obviously Hartford. All right. So anyway, the average rent in Connecticut, $2,800 a month. So it's pretty pricey. Yeah, Justin. Yeah.
I would also just like to say though, I actually think that is low. Depending on we're talking about where you're going to own a house versus where you're going to rent. In areas where you're going to attempt to own a house.
Well, just so you know, for your purposes, I actually was really conservative. I went the top end of the average because I know you're going to come at me with this.
Yeah. I would say that's low.
Okay, so the median home price in Connecticut is $425,784. Not rounding. Okay. So my assumptions were average mortgage rate was about 6.3%. Is that about an accurate one? Because I can change the numbers here at any point.
Okay. Oh, of course. I can't even. This is a spreadsheet where you can change. Oh God! All right, I'm losing here, guys.
The annual tax payment I had at 1.6% of the home value, which in this instance would be about $7,000, $6,800.
Sounds pretty good.
For those taking them out. I assume we had a starting amount of $100,000 to invest. So whether we put some of that in down payment or whether we invest the rest, that's kind of what we're looking at. And I also assume, all right, we've got $5,000 of cash flow. So either some of that's going to rent or mortgage / all the other housing payments, or the rest is being invested. I did not index the $5,000 for inflation. So that is just going to whittle down over time. Okay. We all in agreement here. So I assume we had a 3% down payment. So putting as little down as possible in the house. A closing cost about 3%. Is that about accurate?
That's about accurate.
Okay.
You're doing pretty good with your numbers. Perplexity, did you?
Yeah, I'm looking at it. All right. So I also assumed a realtor fee of 4%. So when you're selling a house, I had to put that in the house value, right? And then, I assume taxes and all that fun jam. But so I saw that the average time you stay in a house was about 11 years. 7 to 11, I don't know, kind of like everything I looked at was all over the place.
So millennial, I guess it is generational. So millennials stay in houses for shorter. Well, I say that historically, people under the age of 60 stay in their house for a short amount of time than boomers. However, currently that may actually no longer be the case because a lot of millennials are, housing locked by their rate. So
the good thing is I've got a chart, so I can give you the 7-year numbers. I can give you 11.
Perfect. The chart is
whatever you want. All right.
I love this.
So basically, at the end of 7 years, your home value minus your outstanding mortgage and plus your stock value. So basically, assuming you took the $100,000, took out the down payment, invested the rest, and then added the difference to the $5,000 in the payment. At 7 years was just over $400,000. Not bad. with it just stock and renting, so doing the difference, and I assumed a 3% inflation on the rent. So is that fair?
That's fair.
Okay. 441,000.
Oh.
So $40,000 difference after just 7 years.
Okay.
After 11 years, you're at 668 versus 732.
Okay. All right. Well, this episode is done now.
We're done. Game blouses.
Yeah, we're apparently done here. All right. Thanks for ruining my life. I'm
She's like, I'm never going to sell another mortgage.
never gonna sell another mortgage again.
But the thing is, your home is an asset, because I'm going to get back to that, because you can still sell it.
Mm-hmm.
You know, at the end of the day, your home value is going to go up, right? So your outstanding home value after 11 years is still 346,000. So you still have a lot of assets or equity tied up in there.
Yeah.
And the benefit of the real estate piece in general is you're using leverage, right? So
Correct.
you're buying something. I'm putting $12,000 down and getting a $425,000 asset.
Yeah. And there's nothing else like that.
I mean, you can technically do that in stocks, but you can lose your pants, as they say.
Well, and maybe that's the question too. So what is the risk reward here? Is real estate a more solid asset, because you don't want to call it an investment? Do you have less risk involved than you do in the stocks?
Well, you know, it kind of depends, because time frame is really important with stocks. If you're looking at, homes in general, they rarely lose value. There's only been like 3 or 4 years in the last 80 or 90 years that they've actually lost value.
Correct.
Right? They just don't lose value, because people need a place to live, and they're not building a lot of houses. So the demand for them is still very high, and we're not making less people. Population is growing.
Correct.
Right. Stocks do have 1-year periods, so about 25% or so of the time where the stock's values can be down. However, you're typically not always selling your stock every year either.
Yeah,
right?
especially like in the worst part of this, right? Like they're down, they're trapped. This is going to be when I sell it. Like, no, that's not.
Yeah, and typically if you go out 20 years with stocks, you've never lost value historically. If you look at rolling returns, JP Morgan has this chart, you mean my charts again, where the worst you would have done is 6% per year over a 20-year span, which is still pretty good.
Still pretty good.
Homes have averaged 3.4% here in Connecticut, and that's even after the boom of the 2020s. So I think if I'm going, all right, do I rent or not? It's always gonna be a personal decision. But if you're looking strictly as an investment thing, you're probably better off renting. I did in my chart after 20 years with the 3% inflation, you're spending $1.5 million on rent. Is that insane when you look at the numbers?
I do that math for people all the time, truthfully, in the equity conversion, in that, yes, I do agree with you, right? If you had $100,000 to put in stocks versus putting 3% down on your house, but the person who only has 3% down to put on their house is not the same person who's renting and has $100,000 to put in the stock market.
Right.
And that's the other real piece to this, is that leverage, is that if you only have $12,000, what does that look like with your rate of return?
Well, if you only have 12,000, I mean, you're obviously gonna be better off into the house.
Yeah.
Right? If you just, because you're gonna need a place to live. I could
Do that number.
All right. What do I knock the $100,000 to? Like 15,000?
Yeah.
Let's see what we look at here. Boop. All right. So, yep, you're at 425 after year 11 with a house, and you're at, that doesn't make much sense, 490.
No, that you got wrong.
I changed
math.
the wrong number.
Changed. We got bad math here.
Oh man. Yep. Starting
The
1,000.
spreadsheet's not as good as we
Well,
thought
no,
it was gonna be. User error.
Well, no, the problem is the contributions are still up there. You're still adding a ton of money per year with the house, with the stocks.
Oh, because of the $5,000 a month.
Yeah. So I guess I gotta this is the problem with the circular math. You got to go crazy. But anyway, I'll adjust the chart, everyone, for those that are looking at it. But anyway, yeah, it'll be a big difference when you could put down that's all you have.
Yeah,
right?
and I truthfully, I think for most people that is the case, right? Especially if we're talking to millennials, right? The average millennial first-time home buyer, our average first-time home buyer is a full-blown millennial right now. It's not a Gen Zer. So it's not somebody in their 20s or even early 30s. It is late 30s to mid 40s as our first-time home buyer population. They're still only putting minimum amounts down.
Right. Yeah.
That's all they got. They've only got minimum amounts down.
Well, because the problem is the values are so high. So we've had such a surge in prices over the last few years. It's really challenging for you to say, oh, I'm going to put 20% down on something that went from $300,000 to $600,000.
Yeah, well, there's that piece to it. And then there is also the rent trap of, if you are making, whatever X amount of money, and let's even round, right, $3,000 a month in rent, what is your after tax?
Yeah, if you're making $75,000, half right there gone to rent, and then the other 20+% is probably taxes, right, between state and federal. So okay, like what do you have left? You can have any fun?
No.
You gonna eat?
No.
And then you have other, car insurance. You probably have the car.
Got nothing.
Right? Yeah.
And so you don't have any leftover money at the end of the month to save to get to that $100,000 to invest, but you are already paying rent, right? So that becomes like a equal swap of I only need $12,000 to buy this house, and then what I'm already only paying in rent, I am swapping, right, for this mortgage payment, and I'm still going to make something off of it.
Right. I guess here's my other counterpoint though, because I think there's two pieces to look at it too. Because there's also okay, I own a house now. That's with the rent, that's the lowest, the max you're gonna pay. With a home, your mortgage payment's the least you're gonna pay because you still have taxes, you still have insurance, and you still have maintenance costs.
Correct.
And you have your time. Right. I was not mowing my lawn when I lived in Boston because I didn't have one.
Yep.
I spend 45 minutes once a week in the summer. Even though my mom's like, again, you're on the lawn again. Yeah, that's what happens with grass. Right?
Yeah.
And there's all these other things that just pop up. Like this week, I had to have our radon fan went, so I had to change that. And then the guy's like, "Oh, your well pump is broken, so it's leaking everywhere. You got to fix that." That was like $4,000 between all those things. God. So like those expenses just come out of nowhere when you own a home. And the one danger I see, especially if you're like, "Oh, I can only afford a 3% down. I'm really tight on my mortgage." Like these things are going to happen, and they can be financially devastating to you. Or that's how you get into debt. Well, like, oh, well, this is an asset, so I got to pay for it, right? And you have that mentality of, I've got to keep paying this into it, and then now you're just trading a small problem for a bigger problem. That's one thing I worry about when people complain too much about not being able to afford a home. Yes, homes are unaffordable compared to where they were in the past. That is 100% true. I'm not going to debate that whatsoever. I think the one thing that I would push, especially the younger generation, is like you probably don't need a home at 25. I know I've said this before, but like I know some people were like, "Oh, I bought my home at 25." That's great if that's like on your vision board.
How old were you when you bought your first house?
31.
Okay, so you were a grown up.
I was a grown up, but it was also a condo. It wasn't like I didn't have to buy a lawnmower. I didn't have to buy a snowblower. I didn't have to buy like yard equipment. Like there's all these things that you have to buy on top of that just to maintain the home. If you want to make it look nice, I mean, you could have it look like a dump and have a couch in the front lawn.
That's true.
You can do whatever you want.
Little frat house chic there.
Yeah.
Well, and I think the other piece of that though too is yes, it is expensive to own a home. I will tell you though is like people think it doesn't cost anything to be a renter. Once you've become a long-term renter though, that is very different than a shorter-term renter. Like if you're renting an apartment for a year, okay, you're not going to do anything to it. I find long-term renters have invested significant money into their rental properties to make them what they want them to be, to have them be useful for them and whatever. And then that is also money you don't get back. Like,
oh yeah, no, that was to me that would be a terrible idea. Why would you do that?
But it's incredibly common.
Yeah,
especially like I'd say once people rent the same unit for over 5 years, they are now putting
their home.
It's their home. They're redoing floors. They're putting in appliances. I don't want that fridge. I want this fridge. And like that, none of that's yours at the end of the day. Yeah. You don't get to take it with you. Like your landlord owns it because you've affixed it to their house. Well,
if my tenant wants to, if you're listening and you want to do the floors again, that would be great. I have no problem with that.
You're like, I am down. Now, the other thing that can happen with real estate too, and we mentioned this briefly in the beginning, is the other piece where real estate is beneficial is your condo, right? Yeah. Is that you were able to hold your condo. So you bought this asset, you lived in it, you got the benefits of living in the shelter, and then you bought a new house and you kept it.
Yeah.
So it is continuing to appreciate at a fairly high amount, right?
Actually, no, that house, that condo in Boston has not moved much.
Really?
It went up in value about $100,000 the first year. I was like, this is the best investment I've ever had. And then since then, it's gone up only about 50. And I bought that pre-pandemic. So this went from like 2016 to 17, it went up 100,000. And then since then, it's just
that's surprising.
Along. Yeah. But anyway.
But even that, right now it's this, you're not only are you making money in appreciation, but you're also hopefully making at least a little bit on the rent. So it becomes like should theoretically be, if done correctly, right? Like a net zero from your like financial standpoint.
Oh no, I think it's a total win because I mean but that's the difference. So I think it's we had the plan of doing that, buying the condo initially. We had the vision of, okay, we're going to buy this condo, and then we're going to eventually live in there, rent it out. I don't think a lot of people have that mindset.
I would actually tell you, not boomers.
Okay.
Boomers own a house.
Yeah.
They live in that house. They want a new house. They sell that house. They buy a new house. If they own more than one house, it's generally a second home.
Yeah.
That's sort of like the boomer model. Millennials and under, I do think are, because we have to be,
Yeah.
because, the boomers ruin the economy for us. We have to be a little scrappier about it. And I do get a lot of people who tell me they qualify. I'm keeping this other property. That was always my intent. I lived in it for a few years. And people look at it as the like owned rental, that like, I'm going to rent something anyway. I will just own it. I will charge my friends rent, whatever it has to be. Now I have an asset and I'm just going to keep it. I think that's more common with our generation than past generations.
I mean, I think that's smart, because I would do that over and over again. If I could tell like younger Derek, and if I actually had probably more money for a down payment, I would have said like, hey, in 2012 or whatever, like buy a condo with 2 bedrooms at least, and then rent the other one out to one of your buddies, because you guys are living together anyway.
Yep.
I was not affording a place on my own regardless. So I think that's smart. And I think the math really changes between stocks and bonds when you have real estate investment. So like when you move away from the home as an investment to the real estate investment, that is a whole different story. I mean, you can certainly over leverage yourself. You can certainly buy the wrong property, have tenant issues. There's definitely a lot of risk. There's certainly a lot more time that it takes to invest. I mean, one nice thing about stocks is you buy them, you don't have to talk to them. They're not a toilet.
You're not, unclogging your
You're not getting like a weird call saying there's a barking dog next door. What can I do about it? I'm like, I don't own that house next door. What would you like me to do about that?
Yeah, the same thing you can do about it.
Yeah.
Well, and I think that is my one other caveat to your numbers here is, right, $2,800 a month rent, fine.
Yeah.
Are we talking the average rental in Connecticut is a 2-bedroom, 1-bath
This is
apartment?
for 3-bedroom. I looked at a
you
3-bedroom.
looked it
Yeah,
up?
I was a 3-bedroom house versus 3-bedroom. I was trying to be fair here. 3-bedroom house versus 3-bedroom rental.
But even that 3-bedroom house versus a 3-bedroom rental, you're not necessarily talking still about the same thing, right? Are we talking about a 3-bedroom apartment in a 3-story building where you have people upstairs, people downstairs, you don't have assigned parking, you have a dog barking in the unit next door, somebody, has a drunk uncle who pees in your hallway? Like, are we talking about that?
Sounds like a personal story.
I could tell you a story about living in Middletown. Yes, there was a drunk uncle and he peed in our hallway all the time. Or are you talking about your 3-bedroom raised ranch in Hebron, Connecticut, where you're on an acre of land, you have your own parking spots, you can put your car in a garage when it snows. Like that is the other piece to it, is that like living situation where you now have control over it. No, you can't murder the barking dog next door still, even if you own the house.
Yeah.
But you do have a little bit more leverage when you are the owner of the property.
Oh, yeah.
And can like call the police, right?
Yeah, well, you can definitely. I mean, the one benefit of owning in general is you can, to your point, make something your own. So like you're not redoing the floors for someone else's house. I mean, that's important. Like if you have a family and you value the backyard, like I lived in Southie in Boston, and parking was a disaster, especially when it snowed. And I love having a garage now.
Yeah, you pull your car in, you're good.
This is my first time in my life I have a garage at work and I have a garage at home, and it is the coolest thing in the world.
You're like, there's a garage here?
There is. It's in the basement. Yeah.
What?
Yeah.
I had no idea. This
It's
is a
only
fancy
for
building.
VIPs, Kelly.
Okay. You gotta be fancy. This is a very fancy building, guys. For those of you who don't know where we record in Derek's office suite.
Yeah.
That is gorgeous and gargantuan.
Yep.
This is
Thank you,
very
David Wood.
nice.
Yep.
Yeah, this is great. But yeah, I think that's the other piece that you have to contemplate, is that you are still, when you're talking rentals, you're still never talking apples to apples. To rent an equivalent, so say you're going to rent that $400,000 house, it's going to be way more than $2,800 a month. A single family home rental in Glastonbury are generally right now upwards of $5,000 a month.
Well, yeah, I think you're also paying for the school system here. That's a
Correct.
big thing.
Yeah, 100%. But like that's the other like apples to oranges piece that's hard. The other thing, and we've talked about this before, we've had a few episodes on it. Investment properties that are second home-esque and or things that you can like Airbnb, that is also a whole other story. As far as real estate investments, that is really an investment, right? That is not, and you're doing numbers there. You're doing hard math to figure out how much do I need to rent this out? What number do I need to rent this out at? How often do I need to rent this out? What maintenance costs do I have? And does this make sense? And those can make a lot of sense.
So I would say and it kind of goes into like the time you're willing to put in.
Yeah.
Because, I mean, there's, all right, when it comes to real estate investing, there's kind of like 3 tranches in my opinion. There's the, okay, I don't want to do a damn thing. Sorry, darn thing, Justin.
Gonna have to bleep that out.
All right. So there's the real estate investing, right? Where you can just do, I want to buy VNQ, which is Vanguard's real estate fund. The most passive way to invest possible. You're essentially, it's like buying a stock, right? You're buying a portfolio. It's the entire real estate market publicly traded, right? Yeah. You could do a private REIT, which is a real estate investment trust. Those get a little bit better margin. You still do absolutely nothing, but they can be really hard to get out of. So that's one thing to worry about. Then the next level is you're renting out a house to someone else. It's a full-time lease. They're there. You're not moving tenants in and out every week. And then the kind of more, all right, I've got to put some work into this, is the short-term rental.
It is a lot of work, just so people know.
That is, like, there's nothing passive about that. Everyone says passive income. There's zero passive stuff about that. But the more time you're putting into something, typically the better returns are going to be. So you're going to make a better return on your Vermont property than I'm going to make on my Southern property. 100%.
But it is, if you were to figure out the like dollars per hour.
Yeah, that's a different number.
That's a different conversation.
And that's where like valuing your time matters. And that's also like, all right, what's the lifestyle? Like, you guys are going to use the house a little bit too. Like, I'm not going to Southie to use the house.
Yeah, somebody's in there. Yeah, exactly.
They're in there. That's it, right? So I think a lot of it's, okay, all of this in general is, what's my lifestyle going to be like? I think at the end of the day, that's what you should start with. This has been a kind of a fun back and forth, especially with my little chart here. But
charts.
It really goes down to, what do I want to design my lifestyle around first? And that should always be your first question.
Yeah, I would agree with that. And I think, again, housing as, and I have said this in other episodes, because I do agree with your numbers, is that, what have I always said? Housing is an asset, but it is also your shelter. So it has this other component to it that is a little bit intangible.
Yeah.
That is a little bit kind of more nebulous.
Yeah, it's like, do I want to have a yard where I know where my kids are going to grow up, and I can design the house around them? They have their own rooms, and we can make exactly like I want it to.
And you're not at the risk of, like, I actually have a client right now who has lived in a single family home for 5 years. They've been renting it. And the landlord came to them a few months ago and said, my daughter wants to move in, so you guys got to get out. Now, her kids are in the school system in this town. They cannot find another equivalent rental in town. She's now going to be pulling her kids out of the school system. She does not know where they're moving. Yeah. One of her kids is in like 4th grade. So it's not like this is like, you know, a preschooler. Right. Like, they've been in this school since kindergarten. And that is a risk for her. Right. And she never thought it was actually going to come true. Right? That she's like, I'm going to live here till I don't want to live here anymore. No, her landlord, her daughter's going to move into the house. You got to get out. Yeah. And she was only given, because this also happens with rentals, is they are now on a month-to-month lease, because they were not renewing leases, because my client also didn't want to be trapped.
Oh, yeah. So it works both ways.
Yeah. Didn't want to be trapped. She has 60 days to vacate her family.
Which is not a lot of time to find movers.
You can't even get an apartment in 60 days these days.
Well, especially month to month, if it's like, I know in Boston, it was like September was a big moving date. So like a lot of properties open up in September. But if you're doing like off season, so you're moving in, we actually had to move in April one time, and we had very few options. Yeah. So like that matters too. So I don't know, I mean, especially I'm sure like even Glasper here, like people want to move because of the school's calendar, right? They want to have a place probably in the summer or what have you. So that's really important. It's to me, it's about control. Yeah. Right. So when you own the place, you have control over a lot more things than you do when you rent.
Yeah, I would agree. So my conclusion here for me is that the math's for you, but only under ideal circumstances. And not everybody is in an ideal circumstance and has $100,000.
I don't know about ideal circumstances. Yeah. It goes, let's say you move in a house and it's just a total disaster and it's a money pit. I mean, that could be a very unideal scenario.
Also agreed. Yeah. Totally agreed. Right. But that's the stuff, like, you can't necessarily quantify or chart all of the things. Derek wants to chart
happiness chart, smiles.
You can't chart all of the things, and there are so many variables for every single individual situation that is where, here is our usual ending here, is that is where talking to your amazing team of professionals comes into play for you, your unique situation, what your goals are, what you're trying to accomplish in your life.
Yeah. It always starts with that. Like, what are your goals? And then work from there.
Yeah. And your goals are to own homes and to call Kelly.
Exactly. Call Kelly.
Exactly. So awesome.
All right, guys. Well, thanks for listening. Like, subscribe, do all the things.